Because always in these morning shows, it's always you, Tevis. That is late.
That's not me. It was
That's
you
the
all
best
along.
way to start the live stream, by blaming. We have 2 Canadians here, 1 American, 2 Europeans, trying to cover a European company, probably one of the best European companies in the market right now. So good morning, good afternoon, everyone.
This is a company that brings the whole world together.
Hopefully it brings our portfolio up and not down today, but you never know. You never know with this one. So, Nebius, expectations. We talked about it literally 2 minutes ago in private, but we shall repeat ourselves.
Yeah, that was my bad.
Let's start with Nate, your expectations.
Yeah, so we were talking a little bit before this, and they said they're going to release their full year revenue guidance for 2026. And essentially, all of us were kind of saying we have no idea what it's going to be. I think estimates for analysts is like 3.5 billion for full year 2026. But I legitimately have no clue. It could be 3.5 billion. They could come in and have insane pricing power and come in with above 4 billion. I just don't know. Especially, we don't know their contracted power they're trying to get. We don't know their active power timelines and plans. And so I'm super excited to see guidance here. I think that's obviously why you invest in this company. You're not buying it for the revenue beat. You're buying it for the future guidance. And so I'm really curious to see how they come in and guide moving forward on at least the revenue side.
Tevis, you want to have a go, or shall we wait until you get the coffee?
No, I have it. I think guidance is going to be important. I mean, look, it's a Q4 earnings, right? So I think providing full year guidance, that's what the market's going to be looking for specifically. I don't know that they're necessarily going to be providing another hyperscaler deal or anything like this. I think the CapEx is going to be important, and just can they meet their ARR? Is the market calling BS on that? And the stock's moving in pre-market downwards, so I think numbers might have just come out.
Yep, down 7%. Yep,
we have numbers already?
Let's see. For now, it says soon to be published on their website.
227 million is what I see.
Where?
Nebius QR for full year. Right here. I can share my screen. Maybe for some reason I get it first. I don't know how. Can we see this? This is their.
Yes, we can.
So Q4, 227 million in revenue. So that would be a miss. Obviously, like we kind of talked about a little bit, we're not expecting revenue. I don't, because is this right? Like, I know you guys, for some reason, you guys can't see it, but.
Yeah, zoom in a little bit.
Yep. Adjusted EBITDA of 15 million. Net income, negative 249 million. Adjusted net loss, negative 173 million.
Oh, now I can see it, like the shareholders line.
Cool. So yeah, that'll be a miss on revenue by about 14 million, which is probably why we're seeing it go down, because that's the initial reaction. Now the rest of it is just sort of.
They reiterated. Oh, they got 1.25 ARR by the end of 2026. 25, sorry. So
really?
well above guidance.
And also the contracted power for 2026 is now above 3 gigawatts.
Yeah.
Really? Oh, man.
They have Missouri and Alabama there as well as new owned sites. And Oklahoma.
Interesting.
And Minnesota as a co-location.
Current guidance for
well above guidance.
16 data centers expected for the end of 2026.
16? They have 7. Okay.
Yeah, hold on. Let's can we throw
can we pull up the press release of all that there?
The core AI business revenue grew 802% year over year to $214 million.
Okay, so this is the letter. So ARR well above guidance. I mean, well above the guidance. The ARR, I mean, it's basically the exit rate for calendar year 2026 is still the same, which I think is fair. Capacity guidance is up now above 3 gigawatts, which is impressive stuff. What else do we see here? Of course, revenue is going to increase significantly because it's a super small base. 24% adjusted
We
EBITDA
ended the
margins.
year. Sorry, bro, but we ended the year with 170 megawatts of active power compared to our target of 100.
I'm gonna say 100 megawatts was holy crap.
Yeah, so 170, 70, not
Dude,
70.
I did not. That's insane.
I'm surprised by the market reaction on like what a top line miss on
I
a
think
company
it's
that
just
a
honestly
double
just
miss.
the. I think it's just algo seeing a double miss and just selling off. I think that's what it is. Because
Like-
this happened last quarter. They missed revenue and EPS because no analysts know how to guide for the company because there's like 4 analysts in total. This is insane, guys. I did not expect 1.25 of ARR and 170 connected megawatts. And they guided for 100. That's
yeah, it's
almost
gonna
like
be a really good call as well. I'm really
Yeah.
excited.
If you see anything in the shareholder letter and I have to scroll down, let me know. Because previously we found like interesting things that were just mentioned in there without being highlighted at all. If you
Achieved
get
our
maybe
first quarter of positive operating cash flow.
really.
Yeah.
They're fully in the
Yes.
servicing stage with Meta now.
Don't get me pumped up. I can't believe they're gonna have 16 sites. Holy crap!
Yesterday, I said in my article that we should have like 20 plus data centers in the next 18 months. So
Yeah, you're right on.
And also with the new acquisition of Tavili yesterday, like you said, it's going to be still operating as a standalone company, so the revenue continues. It adds to the overall business, which is pretty good. Should
they
accelerate.
They reiterated the 7 to 9 billion, which makes sense. I'm glad they reiterated it. I have a feeling, based off this quarter, they're going to raise that ARR guide in the next quarter or Q2. But just my opinion. And they raised their capacity guidance to 3 gigawatts, like you said, instead of 2.5 gigawatts.
Okay, let's see.
Yeah,
I
I'm
just
going through
couldn't find the
shareholders
guidance
letter.
for 2026 revenue, so they probably will say it during the call.
Yeah, they usually say that the guidance during calls for revenue.
Sorry, I'm just
Yeah.
plugging all these numbers into my spreadsheet right now.
Yeah, I'm also
No worries. So they deliver the first tranche of capacity to Microsoft on time in November. Deliver both contracted tranches to Meta on time.
Yeah.
Great. I know we can talk about that.
So sold out capacity again in Q4.
Probably. Yep.
Yeah, that's the way it's going to be for a while, no?
Yeah.
Yeah.
I think so.
I mean, they already told us that 2026 is what, half sold out or something like that last quarter. I think.
Yeah, I'd believe it.
I mean, if they can grow fast enough, I wouldn't be surprised if we suddenly have another Meta deal. Because I mean, the previous one was considered small compared to what they could have had. So, wouldn't be surprised to see it.
We're seeing the stock, I think, react a little better now. It's only down 3.5%. And I have a feeling during the earnings call, it's probably going to help it as well.
Yeah, I'll participate. I'll pick over.
I mean, I just said EBITDA. They're so well on track here. Like, there's no delays. What they said is coming true. 2026 seems like it's going to be quite an interesting year.
yeah, because
Yeah,
now
that's-
because of the scale, the EBITDA is being dragged down by Evrite and Triple Ten.
Mm-hmm.
Probably mostly because of Evrite. So
So
they
yeah,
have
guidance.
$3.7 billion in cash. So there must be a financing deal somewhere, or maybe a prepayment from Microsoft, something like that.
I would guess the latter. Probably prepayment. from Microsoft.
How much cash did they have last quarter?
They had 4 point something, but capex for the quarter was like guided
Five.
for $3 billion. then we bought Tavili, or how the hell you say it. So, I mean, it's
So
impossible.
2.1 billion in Q4 capex.
2.1. So it's way below the guidance.
Okay, we bought the dip. It should go green now.
Actually, it just now it's down 1%. So you put in a big buyer there, Tanner. Shut the stock up pretty quick there.
For me, it was actually a pretty small buy, but I'm running out of cash here.
I mean, and now it's up pre-market now. It's up 0.5%. So it's setting back up. I think, like I said, it was just algo immediate reaction to a double miss. But then I think that people are coming through this and kind of realizing, oh crap.
Yeah. Wait, how much did they do year over year? Okay, they missed, but they grew by what, 800%? 500%?
547%.
Insane.
Yeah, the core business grew by 800.
Yeah. 24% EBITDA margins versus 19% last quarter, and 10% the previous quarter. So EBITDA margins improving.
I mean, cost of revenue is also, in total, it has increased. But if you look at the other things here, things are, again, trending in the right direction as they scale up. But yeah, the 3.6 billion in cash, I do wonder how they did that.
So if they had 1.25 ARR, that means December alone was over $100 million in revenue.
Yep.
Mm-hmm.
First quarter positive operating cash flow. That's awesome. I mean, this is a great quarter, guys. I don't know about how you guys feel.
9 new sites across the US and EMA.
And look in the shareholders letter, they have like the locations there. And yesterday I said that we could expect one more in the UK, one more in France, 2 more, because in the UK, I want to know this because I said in my article yesterday that I think they're going to build their own data center in the UK, in East London, because they said like in the job description that we all saw, like about the collocation and all the speculation around like the one in France and some in the US, they explicitly stated like on-site role in our collocation facility. And then in the job description about the new data center coming in London, in East London, they used the wording as on-site role in our data center. And the only job roles that had that same wording were the ones about Finland, which is the data center that Nebius owns. So I really want to know if this one in the UK is going to be built by Nebius or a collocation, but the wording suggested that it could be like...
That one's pretty small comparatively, right? It's like, what, 50 megawatts or something like this?
Oh, they have something in the map. I just noticed saying like sites with more than 100 megawatts.
Yeah,
So
and look at all the new US sites: Missouri over 100, Alabama over 100, Oklahoma over 100, and New Jersey.
Oklahoma is a collocation, so a pretty big collocation.
Yeah.
Then is this in France?
Yeah, it looks like UK, France, and Amsterdam.
3 in France. We have 3 in France, right?
Yeah, it looks like 3 in France.
Crazy.
Could even be Belgium, but I highly doubt it.
Maybe it's like one related with the EU plan to build 10 gigafactories, or maybe the data one is because I think one of those gigafactories that are being built. There are 10 AI gigafactories being built in the EU right now across 7 member states, and one of them is in France, 1 or 2, and is being built by Data One, which is the company building the New Jersey location. It's in Grenoble. I'm not sure, but I thought it wasn't going to be for Nebius. So yeah, it is in better, but I don't think that one is over 100 megawatts. At least I saw, unless it's not the one from Azure Data Center. because I when we saw the job description saying that they had a collocation in Bethune, or how the hell you say it, I went to search for projects there, and I only found one from Azure Data Center, and I don't think it was large enough to be 100 megawatts. That's why I'm not sure.
I mean, imagine growing ARR by 7x in a year. That's
The thing is, I honestly think they're gonna grow it faster. I think they'll push that guidance above 7 to 9 billion in the next two quarters.
They've tightened guidance before, right?
Mm-hmm.
Like they're not like an exclusive company to just beat and raise. Am I correct in saying that? I thought that they had tightened the upper bound range of their guidance before.
yeah.
They
we
tightened
started
last
lower.
quarter. That's why I thought it wouldn't make sense to meet analyst estimates, because they had like I think between 450 and 630 million dollars, and they narrowed last quarter to between 500 and 550. So
Right.
they had clear visibility like about where they would end the year. And as I said, it really depends on the timing of the deployment. And they delivered the first tranche of Microsoft and Meta contracts right like before the end of November. So that's why we saw ARR of $1.25 billion, which is well above guidance, but we missed estimates. Why? Because the deployment only came like at the end of November, so revenue was only in December and not for the full quarter. And that's what analysts don't really understand here. They really need to consider the exact month at which the capacity is being deployed. You can't just say, oh, Microsoft, the first tranche will come in the last quarter of the year. Okay, but it's very different if it comes in October or in December for the estimates of the quarter itself.
Right.
That's why this miss, I wrote it yesterday, it's not really about lack of execution. It's more about the analysts don't really know how to set expectations yet.
Which is why ARR is a better picture for now. And even the ARR for 25 has been, and we started very small. What was it? 500 to 750 at first, like 12 months ago. Then it went up, and then it went even higher. And now we beat that number. I would be happy if we hit above 8 billion for the year at the end of this year. If they can do 9, that's great as well. But they're pretty realistic, I would say, with their expectations. Some things are out of their control, fine, but realistically speaking, it is one of the better managements out there.
Oh, Reuters just said Nebius to build 240 megawatt data center near Lille, France.
There you go.
Okay, so that makes sense. That's probably the white dot
Exactly.
right
It
here,
couldn't be,
'cause-
as I said, it couldn't be the one in Bethune, because that one is like maximum 50 megawatts, I think.
We hadn't heard anything
Lille is
about that
pretty-
data center in France. This is the first time I'm hearing about it.
Yeah, I don't think they've mentioned.
Well, like even in the hiring or, in all of this other research, we haven't heard about it yet.
Plus, yeah, guidance is in the call, so the move probably starts when Arkady speaks,
100%.
and he speaks and he says stuff, and he's like, "Can we end the call so I can get back
Yeah.
to work?"
I remember that last time. It was hilarious.
Poor Arkady.
Which is alone like almost like a piece that you can look for really good management are the CEOs that do not want to be there. Shopify being another one. Toby Lucky, you're not going to catch him on one of these calls. He's not doing that shit.
I'm pretty happy about these earnings, to be honest.
Oh yeah, I'm very happy. I was gonna ask, you guys see any yellow flags or anything that calls out to you? I'm trying to go through their financial highlights. But Early stage
last-
growth company, so not much to call out.
No, there was a step up in the percentage of revenue that was for depreciation, but that could just be the timing of like Q4. Depreciation went up quite a lot, but obviously that's going to continue to happen as they get more, data centers. But just on a percentage of revenue, I thought that step up was interesting. Yeah, that could be timing. Like I'd need to see it over the next like 4 quarters.
Yeah. As of for 2024 versus 2025, it was 79% of revenue versus 95% in 2024. So
Yeah, for full year.
Yeah,
Yeah.
full year, not quarter. Yeah.
Yeah. Can anyone speak to, because I didn't get a good chance to read through it all, but the acquisition of Tavali or Tavali or whatever, as to how that helps Nebius going forward?
I mean, it's basically. I mean, I'm not an expert on the technology itself, but from a strategic perspective, it's basically another layer of the stack. Basically, it's another integration that makes the platform stickier and more useful for instance, the customers of Token Factory. The goal is to reduce the cost per token, and that is another layer that helps them in achieving that. So basically, it makes the platform more efficient to deploy AI agents in very simple terms.
It's, from what I understood yesterday, it's basically giving your AI agents the pipes to go search the web in a very, very efficient way, fast way.
Yep.
Exactly, because Google is more suitable for humans, because I mean you get a bunch of links, and Tavili, they give the model or the whatever, the platform, the data in a more structured way to an LLM or whatever you're using for your AI agents. Because I mean, we know by using ChatGPT or Gemini or whatever that sometimes it's a bit weird where they go catch some links to somewhere, and like, I mean, I think you understand what I mean, because Google is made for people and not really for LLMs, and this is basically a Google for LLMs. I would say. I've read somewhere that it had like similar efficient or even better efficient than Claude in terms of search.
Yeah, so I saw that it's more efficient than Perplexity on their
but
benchmarks on their site.
Really like fact check, so I don't want to rely on that. I just saw read on a couple of articles that they were really efficient. But I mean, as I said, I won't claim to be an expert on the company because I didn't even know about it.
It's crazy that this company was founded in late 2024 and just got sold for, well, is it around $400 million or so?
Up to $4 million. Crazy.
What they raised a Series A in August of 2025 for like 30 million, and then like a couple months later they just sold, and you're like, what the heck is going on? 30 people.
Yeah. But they will double their workforce, I think, this year. That's what they said. But I mean, it's a young company, but if you look at the customers that they work with already, it's quite impressive.
Yeah, AWS, IBM, Databricks.
Grok with a Q, not
with a
the
Q, yeah.
XAI Grok. Cohere.
Yeah, I think, Tanner, to answer your question, it's just another level to their offerings, right? Like, obviously, with Token Factory, we already know they're good with GPU infrastructure and everything, high-performance clusters. And then they have token generation with Token Factory, which came out in September, October, November, something like that. And so this just gives them another level to add, real native search for their agents. So people want to build agents that can still be within the Nebius, layer, essentially, and get that grounded context via searching the internet.
Yeah, that makes sense.
I just noticed something important about the prepayments from Microsoft or Meta. So they finished the year with close to $1.6 billion in deferred revenue as a liability on the balance sheet, like around 275 in current liabilities and 1.3 billion in long-term liabilities. So this means they got close to $1.6 billion in prepayments already, whether from Microsoft or from any other customers. And that helps funding the capex.
Makes sense. Is the call
and
start
some
at 7:30 Eastern? Do we know? Or 8?
I think it's 8.
It's 8.
Got it.
It's 8. Oh,
It's 40 more minutes of talking.
You guys said it for 6:55, man.
I mean, Tanner, you told me that's what we have to do.
That is not.
I thought it would be at like 8:30. Sorry, like our stream. Then I was like, oh, it's at like 11:55.
You guys are telling me I had to get up at 5:30 this morning.
Yeah, I woke up or sorry, I was talking with Neil, and he said, I said, what time are you starting? He goes, well, I assume it's the same as SoFi. I said, oh, you're starting it at 6:55, and he said, yep, or I guess, or something like this, and I was like, because that's when we start the SoFi one. But their deck is a lot more full than this.
Yeah,
almost flat right now, just down 1%.
I mean, to be honest, if nobody looked at the stock reaction, you only looked at the presentation and the numbers here, you would think this thing would be up because the numbers are good. The fact that people are not happy because the stock is down means either they didn't look at the numbers or, well, they just don't care about the numbers. Stock has to go up.
Yeah, it's just algos.
You know what company we should be talking about right now? Crocs is up 13.6%.
Makes sense.
Honestly, cut all this data center bullshit. We need to be buying Crocs.
I actually know the Crocs thesis quite well.
Yeah,
because of a friend of mine that was an investor, but
what is it?
Already sold. He sold during the tariffs drama because of the like they would, if tariffs had held, they and like Nike and On and whatever, all those apparel stocks would be crushed. But I don't really love management, to be honest.
Everybody needs shoes, and you could sell 2 of them to every customer.
Yeah, but not Crocs shoes. I mean,
plus you can have the add-ons, right? So that's the extra
accessories.
This little thing that
I would never wear Crocs, man. It even feels like the texture of the material. It's so weird. Maybe I'm a pussy, but it's so weird, man.
Thank you, Emmanuel. I have Crocs behind me, so maybe I contributed to the good quarter.
Yeah.
I'm cheering for the company. I just don't get it. Like, why so many people like to wear it?
I mean, it seems like 26 so far is the year of the non-AI story. Like AI software gets crushed because the market thinks that software companies will go out of business because AI. But then if you look at AI stocks, they're also getting crushed because I don't know. So who's winning here? I guess Crocs, maybe Build-A-Bear as well, like these types of companies.
Yeah, I mean, some quick numbers on Crocs. Revenue ended up falling by 3.25% year over year. Net income fell by 71% year over year. Let's see their net income margins here. Yeah, good is bad and bad is good. You don't want to buy companies growing at 550%. That's scary. Which I'm sounding like I'm being a little condescending, but honestly that is scary because things can change very quickly. But they have a net income margin on Crocs of roughly 11%, which is like pretty historically low for them. But I think the thesis was that it was already way too sold off. So, anything but bankruptcy is actually leading this company to go even higher. Also joking. I'm sure Crocs is doing fine. Neil has them, so.
I actually have 2.
I never expected to be discussing Crocs.
They sell them in pairs, Neil.
Then 4. Sorry. I have 2 pairs.
I knew what you meant.
Wait, so Nebius is going from 100 megawatts expected. They're currently at 170, and they are on track to reach 800 to a gigawatt of connected power by end of 26. Did I understand that trajectory correctly?
Yes.
Okay.
Yeah.
I was like, I have to have something wrong. That's crazy.
Yeah, they're
Say that again.
basically
I missed that.
7xing their connected power in the next 12 months.
Their guidance for connected power, Tanner, was 100 megawatts, and they hit 170.
Yeah.
And this year they're like, we're gonna hit 800 to 1 gigawatt from 170.
Which honestly,
Yeah.
they'll probably. I mean, if we look at their previous earnings, like they're probably going to beat those expectations. Like,
Yeah, it's all those new data centers coming online.
yeah, which is insane.
Which means the full impact will probably be seen in 27. I mean, that's the whole thing with these types of companies. Same with Iran. It's like we have this, but it's the exit rate basically.
What did
I'm
Iran
curious-
do in AI revenue? They had like 17 million or 16 million in revenue. AI revenue. Do we know? It doesn't matter.
We're green, man.
Not anymore. Ah, yes. Flip flopping. Core
Take your
is up
screenshot
1.5.
while you can.
I'm curious your guys' opinion on whether to own Nebius, and you believe in this name specifically versus the rest of the industry, or you're a fan of some of the larger clouds, other neo clouds, or maybe even the chip providers. If you guys don't know, by far my largest position is NVIDIA, and this is sort of another way for me to play the build out space. But I'm curious for you guys.
I'm bullish all build out space the next 24 months, but I think Nebius is differentiated. It will be differentiated by then, and so that's my longer term play. But I think over the next 24 months, like it's hard for me to see Nebius, Iron, CoreWeave, all those names not do well over the next 24 months with the build out we see, especially the CapEx build out. I mean, yeah, it's hard for me not to see all of them do well, but I think Nebius will be differentiated by the time we hit a lull in the demand. I don't know when that's going to be because I don't think. I mean,
Well-
we've still not seen any signs of slowdown. So
Actually, on that, Tanner, I don't know if you have your spreadsheets or maybe Manuel, but I'm curious to see the ratio between the connected power versus contracted power currently and in guidance. I want to see if that's expanding or contracting. In other words, like relative to what their future commitments are, how much are they bringing online, and what are they guiding? Like, is it getting wider or is it getting narrower? Does that make sense?
Yeah, I don't have a spreadsheet for that though.
Okay, sorry, can you repeat? I was not.
So they have a current
Familiar.
number. They have a current number and a guidance for connected power, and they have a current number and a guidance for contracted power. I want to see what the ratio is currently contracted to connected. Like, what are their commitments versus what have they brought online, and what are they guiding for? Is that widening or is that getting more narrow? In other words, are they meeting the demand or are they making more promises and it's just sort of wider going forward?
The connected power guidance is the same now. They just raised the contracted power guidance. And it's not a range in the contracted power, it's over 3 gigawatts. So, I mean,
Right. So they're
like
not providing.
6 months ago, they said over 1 gigawatt. Now they're saying over 3 gigawatts. So we can't really rely on 3 gigawatts as a concrete projection, let's say. But with connected power, it's different because they say explicitly between 800 megawatts and 1 gigawatt. So it's difficult to make that assessment because one is a clear range and the other one is a floor. So it's.
I mean, if they do deliver, I mean, of course they're going to raise their capacity guidance, like from
But
now.
I think
until
the
end of
active
year.
power answers your question. Like they're clearly delivering because
Right,
from the beginning
right
of the year, they were expecting 100 megawatts of active power by the end of 2025. Like that was a target set like really early in the stage, like really in early stage. Sorry, but like in 2024, I mean, they were clearly very conservative because they were new to the market. They didn't really know what to expect, and the market evolved like significantly. So I think what I would like, how I would answer you would be by looking at like not really comparing the connected power with contracted power, but more like looking at how fast they are deploying capacity. And so far, they're deploying faster than they at least said they would. And I wasn't really I was a bit afraid because of the like, how can I say, like the concerns about the delays from Data One around the New Jersey location. So I was afraid they could have some problems in reaching that 100 megawatts target of active power, because that's like a target that wasn't really raised over the past quarters compared to connected power and contracted power. So that maybe that was a factor that scared a lot of people. They thought it was just talk and like not showing any execution like above what should be expected. But reaching 170 megawatts, it really surprised me on the positive side. So I think at least I'm not concerned about knowing that they're executing. And we could see, like, I shared a lot of posts from LinkedIn of workers there, and like even people from like the municipality in Mansala, Finland. So they are just a team that loves to work in silence. And I mean, I know a lot of investors prefer to have a press release. Like, I'm not trashing Iran or any other company, but I don't want my company to issue a press release saying they bought 4,000 GPUs. Like, it doesn't make sense. It might move the stock, but I mean, that's just business. As like, it shouldn't be anything to praise. Like, they bought
it's an expectation for what you're buying.
They bought a few thousand GPUs. Like,
Yeah.
I would love to see more clarity, like regarding, for example, the contract with Microsoft or the contract with Meta, or like some of the locations. And I think they understood that. That's why they gave such a clear outlook in terms of getting to 16 data centers. They understood that we were kind of not tired, but annoyed by, I wasn't, but most investors, about not having some clarity. Because I mean, raising the target from 1 gigawatt of contracted power to more than 2.5, it's really ambitious. So people were like, are these guys just saying some bullshit to pump the numbers, or they have really a clear roadmap to get there? And I get it. I wasn't really concerned, because I let's say know this team, which is a bit dangerous to say, because I'm not blindly trusting them. I just have evidence that they like to do it. And as I was saying, we were getting like hints from LinkedIn posts of like people that had the knowledge about it, and other evidence, like the community is really working hard to get some more clarity. But overall, I think they understood that, and they're giving a bit more, not guidance, but a bit more clarity about these 16 data centers. Because to be fair, I mean, they follow us, and they know that we already knew about many of those deals, like the ones in Independence, the one in Alabama, the one in Minnesota, the one in Oklahoma, the one in Bethune. They knew that. That's why they changed the job descriptions as soon as we posted them on X.
I love the nerd retail. The fact we found those job descriptions, which means we knew data centers were being built there. I mean, it's the best. I love that.
Yeah,
I think you're right, though.
I prefer a team like this.
No one trusts. I mean, I still feel like the market doesn't trust Nebius numbers, and so they need a very clear roadmap of what's happening, how they're going to get there. Because, like you said, I think they threw up that 79 billion of ARR, and I think the stock sold off, and so the market was like, "Yeah, okay, sure, well, BS." And so they need a clear roadmap on how they're going to get there, and I think the first step is showing data center build out. And so now that we see that they're mapping 16 data centers, I think, I mean, obviously, I'm more confident. So I'm curious. I'm curious to see what they say on the call, though.
There's a question in the chat that I'm kind of curious for us to pick up on the CapEx spend for Q4 being below guide. What do we make of that? Like, the CapEx spend being below guide in Q4. I could see one side of that being bearish, because it's like, well, you need to spend more CapEx in order to get to your targets faster. But maybe I'm thinking it very one-sidedly.
Yeah, either there was a small delay, so you're going to see the bigger impact in Q1. But then again, they did over-deliver, so something went
I'm wondering that too.
Q4.
Like they over-delivered, but like you said, they missed the CapEx by like 900 million. So did they get a deal on something? Did they find a way to build it cheaper? I doubt it. And so we're
Maybe
gonna
they
see
have
it come in Q1.
some kind of deal with Nvidia where like they
Maybe.
give you the GPUs and you pay like 3 months later or whatever. Like because
Buy now, pay later.
Yeah, buy now, pay later.
yeah, it could be like depending on the mix of co-locations and build to suit data centers. But Arkady said that 80% of capex is GPUs, so that would be like not enough for such big difference. So I think they just don't, and this is like on top of what I was saying before. I think they don't like to share much details about contracts exactly because of this. Just first, Nebius, not Nebius, Nvidia, Microsoft, and those companies might say like keep it between us, because that would probably influence all the other contracts. Because what if Nebius just says, "Oh yeah, we got 20,000 GPUs and we're going to pay it in 3 or 4 months," and then all the other companies would say, "Whoa, I want the same thing," or something like that, or "I want better terms." So I think they, due to the very good relationship that they have with Nvidia, and I'm sure like Microsoft contract also has some differences in terms compared to other companies. I mean, it's normal, for it's business as usual. So I understand why they keep so many details hidden. I understand also why some shareholders would love to know those details, and that's why there's some not trust, but at the same time trust that you have to have on the management team. And so far, that trust is paying off, and I don't see any sign like to be worried or to be skeptical about this team executing or not executing or lying to shareholders or whatever. Because to be fair, the numbers look unrealistic, but at the same time, in the following quarter, they proved them to be realistic and to be even conservative. So there's a clear mindset of under promising and over delivering. At least that's how I feel.
You gotta love Russian engineers, right? I feel like that's like the definition of under promising, over delivering, in terms of just investing in Russian engineers.
We can't really look at under promising and over delivering based on analyst estimates, which is what most people do, because analysts have no clue how to model like quarterly results for this company.
I mean, and for anyone that was dunking in the chat, we are now up 3.7%. So I guess now automatically this makes it an amazing company and an amazing report.
It is officially good. Before it was bad, but
it's not Croc's good, but it's getting there.
It's driving me nuts, like beyond belief, that you have this chart set so far. Like, let people see the green. It's not moving.
Do you want to see the green?
Yeah, I want to see the green.
I want to see the 1 second.
Yeah, go to the 1 minute 1 seconds.
But we do see it. Here you go, you bunch of degenerates here.
You're learning how to stream in real time.
You know, Tevis, you asked for it. So I think like a ratio, like time to active power would be a good one to come up with. Because all the rest is cute, like the contracted power and all of that. But at the end of the day, you want to see the active power. So like the time to active power would be a good metric to have.
It's interesting that for contracted power, they just put a bottom threshold and not a range. They just stop giving, like they're not even saying, hey, 3 billion to 4 billion, because they're going to have to push it up more and more throughout the year. So they're like, hey, minimum 3, and we could do 30 or we could do 3, you know?
Yeah. They did that last quarter too, where they said at least 2.5 gigawatts. Now they're saying at least 3 gigawatts. So I'm sure it's going to keep going up to 4 gigawatts probably if they want to continue building out.
Yeah, if we get to 30, that's going to be bullish.
30 gigawatts?
Yeah, sorry, that's supposed to be a joke, but no one laughed.
I was like, wait a second.
No, I was trying to process 30.
30 gigawatts.
Maybe we should also have data centers in space.
Just a comment that Tevis made.
They could just build infinitely in the span of 12 months. I'm curious, I guess, before we have about 50 minutes of the call. What are you guys looking to hear? I think obviously for me, I want to hear just more roadmap talks, more confidence in just their reiteration of guidance. And also, I really want to hear about this Tavily acquisition and how they feel it plays in. We see them continuing to build that quote unquote we call the full stack approach. So they have Token Factory a few months ago, acquiring Tavily. And so I'm curious to see, like, are they going to come in and say, yep, we have everything we need, or are they going to kind of give the tonality that they're still interested to keep building their stack and acquiring companies or building products?
Do you think Arkady is going to get asked about demand again and get frustrated?
Yes, yeah. They're going to be asked, "Oh, so you were thinking an AI bubble?" He's going to scoff on the call and be like, no.
He's going to say like, "Operator, please kick these analysts from the call."
We don't get that enough.
I don't want to waste my time with this bastard.
I mean, this time we didn't get any enterprise logos in the shareholder letter. Previously, we did get some logos. Fine, they're anyways going after enterprises and AI labs. Would be interesting to see if they talk about if they got some wins there. He's probably going to talk about the capex, how much capex they're going to spend now, why it was lower in Q4, which again, it's lower in Q4, yet we did beat the expectations by quite a lot. So it's not the worst thing out there. Probably sold out for the majority of the year. And then, it's the same thing. It's like we see a lot of demand. We cannot move fast enough, etc., etc., etc.
They didn't show out that at least the last shareholder, they showed out the shareholder letter. They showed that they sold out of capacity. They didn't show that this time. Do you guys think they fully sold out? I mean, I'm curious.
For
What do you guys
26.
think there? No, for the quarter, because they sold out of
did.
capacity. Did they put it in there? I didn't see it.
Yeah.
Oh, okay, I'm just blind then. Disregard me.
I didn't see it either. No, they did. Never mind. It took me 2 seconds.
Oh, I see.
We
They
operate
just
at
put it
peak
in more of a-
utilization. We operate at peak utilization during this quarter, and we're sold out of capacity in Q4.
I got it. They put it more of a bullet point rather than a pretty little graphic. I guess because it's now just sort of that was the big little headline they wanted to show. Now it's just going to be an expectation moving forward that they're
Because
going to
they don't care. Arkady doesn't care. He's just, let me build big company AI powerhouse. And that's it.
Buy GPUs, deploy them, repeat.
Yeah, it's fun to follow a company that, probably the first time that I took a look at this business was in Q2, maybe Q1. But, even Q1, we were doing $55 million, then 105, then 150, now at 227. It's like, if you looked at this 6 months ago, we're now more than double the business in revenue per quarter. What will this look like on a quarterly basis through 2026? And is that even something that you can model for? Like, can you use traditional metrics and judge this company on, hey, you know what, the price to sales, the PE ratio eventually looks high. It's like, okay, but in 6 months from now, it'll look completely different.
Yeah, no, exactly.
So I just wouldn't let that, conventional wisdom, bleed into how you think about Nebius.
Sorry, an important thing that a lot of people were speculating that this price action, the selling pressure, was because Nebius was using the ATM program, and they stated that they hadn't used the ATM program like for a single share.
Oh, really? Interesting.
Which is, again, what I said, they can't use the ATM program during the quiet period. So I said that when a lot of people were speculating, and many started to say, no, that's not exactly how it is. And to be fair, at some point I wasn't 100% sure. So I really wanted to know more about this, but it wouldn't make sense for them to issue shares at a price below the last offering. It just doesn't make sense. And they clearly said they were going to be dilution sensitive when thinking about this. I think if they said they used, it would probably scare a lot of people. But
All right,
I
so
really...
Call's coming up in close to 10 minutes. 13 minutes.
Tanner, Tevis, Manuel, what are you guys looking forward to hear on the call? Just curious.
I mean, the most important probably for the market is revenue guidance.
Yeah.
But I think another very important thing for the market is the capex guidance, because I think analysts are estimating like they are estimating like $10.6 billion in capex, and that's really, like, in my opinion, I think it will be way higher, like way above that number, because the expansion plans are really aggressive, and they need to spend capital. Like, this is a capital intensive industry, so it's not surprising to see like $15 billion. But again, that will depend on the mix of collocations and own data centers. But I think it's something that the market will clearly be focused on.
Yeah, I mean, I agree with that. Anything that would add on to commentary regarding some hyperscaler deals would be nice if they further talked about, where they're sitting with Meta, if they're, still talking about potentially increasing that overall deal size now that potentially they will have capacity for them. Maybe that's even after 2026. But any sort of commentary on large names. Maybe I'm just hopeful that there is that type of press release. I mean, it's not all just about stock go up, but it feels nice. And I've been buying enough down here where I'm ready to see triple digits again.
It's interesting, like last quarter when they did the Meta deal, they said they were supply constrained, and then they delivered both contracted tranches to Meta on time in the servicing stage. Like, I would want to, obviously they're not going to talk about this on the call, but my first thought that comes to my mind is like, all right, like, when's that Meta expansion going to come in? And how's that going to look like? You have 16 data centers coming online, or, going to be operational by end of 26. Like, I'm waiting for it anytime now.
I think these type of companies like Meta, Microsoft, and hyperscalers in general, they want the capacity of the contracts to come from the same data center. And this one, I think it's tied to Finland, not the entire location, because Finland has been operating since the beginning. It was the data center that they inherited from Yandex. So they obviously had a lot of small customers there. But I think the Meta contract was a new cluster of GB300s that Nebius deployed in late November. And they didn't confirm this, but it's based on what I could find and some things I inferred, obviously. But I think the Meta contract is the GB300s that are clustered in Finland. And I personally think that maybe Finland will have like a huge expansion, to a lot more capacity than they anticipated. But I try to see like satellite images or like even local documents to see if it's like feasible in terms of like territory, because I mean the expansion obviously takes a lot of space, and I think it's kind of inside a forest or something like that. So I'm not sure if there are rules that may stop them from doing so. But that's why I'm not sure how would an extension of the Meta contract happen, because maybe instead of an extension, there would be like a completely different contract, like tied to another data center. And this location in Lille that Reuters said they're doing a 240 megawatts data center in Lille, I think this could be for an hyperscaler. Like, maybe it's not, but if we're like trying to think about hyperscaler contracts or Frontier AI Lab contracts, I think we need to consider the big locations. So it's not going to be like, let me check the map again with their. So it's not going to be.
Why would the hyperscaler want the deals to be serviced out of the same data center? Like, what's with the preference there?
I can't really explain the logic because I don't remember, but I've read that somewhere that contracts are usually like from that same data center. It's a preference from them, probably because of the uptime or something.
Probably just reliability on that side.
Exactly, probably about that, because
it's uptime
imagine like for sure. Nebius has data centers across the globe. Yep. They probably don't want like 20 megawatts in Finland, 20 megawatts in the US, 20 megawatts in UK. So it probably has to do with the uptime, the latency, and like I think Meta probably wants like more capacity outside the US because they're building their own capacity in the US, like many data centers, and probably they're trying to rely on Nebius and companies like this, even CoreWeave, for capacity a lot like around the globe, because they need capacity like everywhere. Obviously, they need a lot more in the US. That's Nebius already stated that customers need more capacity in the US. But if you want capacity with the best efficiency possible outside the US, Nebius is a logical choice. And even CoreWeave. I mean, CoreWeave, I think, has some pretty good locations outside the US as well. But I mean, they also have big contracts with Meta, so it makes sense. This is just my view of things, that Meta is trying to fulfill the international capacity with neo clouds. Instead of doing it in the US, they're building their own like huge data centers in the US. So from the locations we have above 100 megawatts, like according to that map that they have in the shareholders letter, it's only Missouri, New Jersey. New Jersey is for Microsoft. Missouri, Alabama, and Oklahoma are in the US. And then the only one above 100 megawatts is in France, this one with Lille, in Lille. So I think if we get another hyperscaler deal, maybe it's with Meta, maybe it's with this location, but it's just speculation, of course.
Mistral is from France. They're looking to invest, I think, as 1.2 billion euros in Sweden to build out
I saw that
data centers there. I
wonder.
wonder.
Maybe in Scandinavia they have the same climate conditions that they have in Finland, so they could replicate the same efficiency and the same methods, the same cooling methods and everything that makes it so efficient. I think other Nordic countries would be a good place to build more data centers. Actually, I mean, they're always dependent on like regulators and capacity and other companies building, and so
you just really reminded me, Neil. I don't know if you guys saw the news yesterday, but Meta said that they're building their own data center in Indiana. Did you guys see this at all?
I mean, it makes sense that they need to build data centers to keep up.
Which is crazy. But I guess that's where a lot of that CapEx is going.
Oh, yeah.
Is that another new data center, or that was already part of the pipeline that they're expecting?
I'm not sure.
Prometheus and Hyperion and a couple of their other Titan clusters and stuff that they've announced sort of like probably a year ago at this point.
I'm not sure. It dropped yesterday, so it might be. No, they said today we're breaking ground on a new state-of-the-art data center in Indiana, one of our largest infrastructure investments to date. So it might have been planned, and now they're starting construction or a new announcement. I'm not sure.
Yeah, okay.
Yeah, it's a $10 billion data center.
Which is crazy. It's half the market cap of Nebius.
It's insane. Yeah, it's insane. All right, 5 minutes to the call.
I also saw the subsidiary information on the shareholder letter. Triple Ten is growing 88% as well.
Yeah.
It's crazy.
But it's a really small business.
Yeah, I'm gonna say it's a tiny business.
Yeah, but it's good green shoots for all of their sub businesses. Like Avride is having a lot. ClickHouse with the valuation raise and Triple Ten as well. I'm not taking a lot around Toloka, but yeah.
And not Tevis, because they will remain an independent company as well. So it's another revenue stream.
I don't like that they didn't include the percentage that they have in ClickHouse. I mean, I know that we can sort of defer that it's probably still around 27% or something like this, but they should let new investors know that it's that high of a percentage.
Yes, I agree.
Because I mean that's a huge deal. They just raised to a new valuation of $15 billion. It makes up for a meaningful percentage of the overall market cap in Nebius. You should be loud and proud about that.
See, this is the Nebius team. We own some ClickHouse. That's
yeah.
It's just like, all right, thanks guys, appreciate it.
Yeah, like the change in valuation was bigger than the Meta deal, and they're like, yeah, I mean, we're
Yeah, we still own it, so it's like,
still there.
all right. Yeah, I think ClickHouse will definitely get another raise this year too. Honestly, I don't think they're done with the raises. I think we'll see something in Q3 or Q4 this year for ClickHouse. I know long term they want to divest from it, so I'm curious to see if they maybe talk about that too. If they have any plans to divest a little bit of it, sell a little bit off, sell all of it, whatever. Moving forward, they probably won't talk about it.
I think it's still early days, man. Like,
Yeah,
Databricks
sure.
isn't even public yet. You know, ClickHouse at this rate is raising money every 6 months or so. So, why not? We'll just wait another year, and they're gonna have
the calls live
valuation. So,
Oh, is it?
The call is not live. It's just full of music.
Okay.
I would say Toloka is probably one that they would divest sooner because as of Q2, they don't have any more voting interest in Toloka.
Yeah, they have less than 50% voting interest, but I'm not sure if if they have like over 50% an economic stake. Because Reuters said that when the deal with the CTO of Shopify and the investment arm of Bezos happened, they included that, but we never got an update from Nebius, so it's really hard to set expectations. In my models, I always account for a very low percentage, like in case there's an exit event, because I mean, even if they own a lot, they will get diluted. If there's an IPO, they will get really diluted. So I always consider the subsidiaries as like a low percentage in terms of exiting the position. Because I mean, for example, they own like 80% of Avrite because the employees own 20, but on an exit event, it will be impossible to like to still retain like 80% until there. Because and now Uber also invested, so it probably is even less than 80%. We don't really know the details, and as Tanner said, that's something I would really like to know. Because even ClickHouse, we can infer some things, but it's not as easy as it seems. Because there were two funding rounds since that 28% update, so it could be even like in the 15% now. Like it's hard to really come up with a final conclusion, let's say.
You still listening to music, Neil?
Still listening to music, yeah.
Okay. Yes, we will be joining the call, and you guys won't have to change or move anywhere. It'll be live stream right through the YouTube stream or wherever you guys are viewing from.
The music 3 months ago was a bit better than this lobby music. I think 3 months ago it was like super hard music.
Sell.
Yeah, that's the Paris signal.
Yeah.
It's actually why we're crashing right now. People are not liking the lobby music.
Dude, why can't these all calls be like a Robinhood Palantir call? Like, what are we doing, man? Obviously, Russian engineers are not going to take that approach, but I would love if companies just all went that way.
And the Robinhood call is literally like a sports press conference after and before a game.
I love it. I love it.
No,
I love Palantirs too. When I first invested, like
they would be so nervous. Like
yeah,
maybe.
they would be.
Bro,
I remember like the not the first, but like the second or third call they had. One of them took a picture on the room where they were all like together, and it looked like a I don't know, man, like
a hostage scenario.
No, like a college like teamwork or something like that. They were all just like in a desk, like some with the legs crossed and like just listening and talking. Like it was like quite funny, but they were so happy. They were really like, I love their energy. Like I'm probably not probably, I'm for sure biased, but.
You can feel Arkadi's annoyance when analysts asking questions through the sound. Imagine.
I would love to see him in person. He'd roll his eyes, like
no.
Throw his hands in the air.
From some people that know him, they said that he's really like a cool guy and like a chill, like not like he seems. he just like hates these kind of institutional talks.
Formalities. Yeah.
Yeah.
Robinhood says the earnings call are live. I don't know if you're still hearing music.
I just went and clicked on the earnings call to hear it. The music.
It's still the music. I mean, the Palantir call, honestly, I'm still shocked that they don't have more than Dan Ives and Mariana as analysts.
Yeah.
It is insane.
Yeah, 100%. I think it's just a spite because those are the only two analysts that actually were bullish the company when they were down in the dumps. It's now out of spite. They're just like, we're the only analysts you're ever going to bring on because you believed in us, which is,
I mean, they're 3 minutes late. That's
yeah,
not very Russian.
They're becoming more American as we go. They can wait. They're fine. We just crushed.
yeah. Like a superstar. Like
Yeah,
the
like,
rock
we'll
stars are like they'll be here when I want to come out on stage.
Yeah.
The presentation will be followed by a Q&A session. If you would like to ask a question, you can click the Ask a Question tab in the top right of the live stream player. Then just type in your question and click Submit. You can submit questions at any time during the presentation, and the Nebius management team will try and answer as many questions as they can during the Q&A portion of the call. I will now hand over to Neil Doshi, VP Head of Investor Relations, to start the call.
Thank you, and welcome to Nebius Group's fourth quarter 2025 earnings conference call. My name is Neil Doshi, Vice President of Investor Relations. Joining me today are Arkady Volozh, Founder and CEO, and our broader management team. Our remarks today will include forward-looking statements, which are based on assumptions as of today. Actual results may differ materially as a result of various factors, including those set forth in today's earnings press release and in our annual report on Form 20-F filed with the SEC. We undertake no obligation to update any forward-looking statements. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in today's earnings press release. The earnings press release and shareholder letter are available on our website at nebius.com. And now I'd like to turn the call over to Arkady.
Thanks, Neil. And thanks to everyone for joining this call. Well, 2025 was a very strong year for us. Our team did an outstanding job scaling capacity and delivering it to customers with speed and reliability. We also made great progress in developing of our own hyperscale AI cloud. But before going into more detail around our 2025 results, I want to take a step back. It's hard to believe we only launched this company a year and a half ago. At that time, we have built the foundation of a global AI cloud business growing at exponential scale. And we have been operating with very high intensity, building and scaling at extraordinary speed. Today, we are already one of the world's leading and most reliable AI cloud compute providers. We have attracted a diverse pool of clients who value the quality, performance, and flexibility of the platform we built from the ground up. And we have an amazing team who every day seem to do the impossible. And I know they will continue to do so. With this foundation, we're proud of what we have achieved and confident about what we will be delivering. Now back to 2025. As I said, it was an excellent year. We exceeded our financial targets, and we significantly exceeded our capacity plans, setting the stage for the next phase of scale. Demand remains robust, and our pipeline continues to grow substantially. We sold out of capacity in Q3 and Q4 last year, and we're already now in Q1 of 2026 also sold out. Even before we bring capacity online, it's often sold out. As a result, the average contract duration of new cloud customers grew by 50%, and the prices of GPUs didn't fall, even on previous generations of GPUs, as the industry may have expected. Customers are demanding more compute and increasingly sophisticated solutions to run their AI workloads. AI startups are quickly evolving to real enterprise scale customers with revenues from their products resonating with real customers. Their demand quickly grows from hundreds of GPUs to tens of thousands. This is already a range the market saw from the biggest customers last year. We're seeing the same trends in the enterprise, who are utilizing AI for more and more vital business processes. Meanwhile, access to compute remains constrained. This imbalance creates a favorable environment for us as we secure and deploy more capacity into a robust demand environment. To capture this opportunity, we are accelerating our capacity plans. Just today, we announced 9 new data centers across the globe. Last quarter, we said we would secure 2.5 gigawatts of contracted power by the end of the year. We are already at more than 2 gigawatts now in February, which is why we are raising our forecast for 2026 to more than 3 gigawatts. And we are well on track to deliver 800 to 1 gigawatt of those as available data center capacity, just like as we spoke about last quarter. Capacity is one of 2 dimensions of our growth. The other is product. Our main strategic focus is to scale our core AI cloud business, which is our multi-tenant AI cloud. We will expand our platform both organically and through targeted acquisitions that can enhance and accelerate the development of this platform. We recently launched Token Factory, and this is an example, a testament actually to our in-house capabilities. And we're also very excited about our recent acquisition of Tavily, which adds agentic search capabilities to our customers, and also brings almost 700,000 developers to our ecosystem. Based on the strengths in demand and our strong execution, we remain confident in our plans for a year ahead. We are reiterating our annualized run rate revenue of $7 to $9 billion by the end of 2026. When we announced this target 3 months ago, there were questions about our ability to get to this range. Over the last few months, our conviction in this range has become stronger. Why? Because we exceeded the high end of our 2025 ARR guidance and showed more than 1.2 billion ARR. Because we already contracted more than 2 gigawatts of capacity and are on track to exceed 3 gigawatts this year. Because we have already delivered all of our capacity for the Meta contract. Because we are on track to deliver the capacity for Microsoft through the course of 2026, exactly as planned. And lastly, the demand for our AI cloud continues to be strong. Pricing is strong. We're seeing more and more customers coming into the platform and committing larger and larger and longer contracts. Everything we build, we sell. We're in the very early days of one of the biggest industrial and technological revolutions in history. That's what we believe. And Nebius is quickly becoming the AI cloud provider of choice. I want to thank again all of our employees for their dedication and hard work, as well as our shareholders for your trust and support. And we will continue to deliver. Well, now I would like to hand the call over to our CFO, Dado Alonso. Dado, please.
Thank you, Arkady. Indeed, 2025 really was a fantastic year with great execution and delivery. We exceeded the targets we set, outperforming our ARR guidance and achieved positive EBITDA at the group level. We also raised significant capital to fund our growth during the year. Now, Let me provide some color on the results, discuss our financing plans, and then I will conclude with 2026 guidance. In Q4, we delivered group revenue of $228 million, representing year-over-year growth of 547%. Revenue grew 56% from Q3 to Q4. Annualized run rate revenue for the core business stood at $1.2 billion at the end of December, exceeding the high end of our Q3 guidance range of $1.1 billion. The results of our core AI cloud business were even more impressive. Revenue grew 830% year-over-year and 63% quarter-over-quarter. This was driven by high utilization, strong pricing, and strong execution. As Arkady noted, we sold out our capacity once again in Q4, as demand continued to significantly exceed available capacity. Even as we delivered such strong growth, operating leverage and spending discipline enabled us to achieve notable progress on the bottom line. Group adjusted EBITDA inflected positively in Q4, consistent with our guidance, driven by the strength in our core cloud business, where adjusted EBITDA margin expanded from 19% in Q3 to 24%. Turning to the balance sheet, we ended the year with $3.7 billion in cash and cash equivalents and generated $834 million in operating cash flow in Q4, which was primarily comprised of upfront payments from our long-term agreements. These early cash flows will continue over the course of the year as we execute against these commitments, providing us with significant visibility into future cash flow. Our cash on hand, projected operating cash flow, and strong balance sheet position us very well to fund our capacity build-out plans for 2026. I will share more detail about our capital plans in just a moment. Now, I will turn to 2026 guidance. As Arkady mentioned, we remain confident in our ability to generate annualized run rate revenue of between $7 and $9 billion by the end of 2026. For the full year, we expect to achieve between $3 and $3.4 billion in revenue. Starting in Q2, we expect to begin bringing online some of the new sites we announced today, with the majority of the planned capacity to be deployed in the second half of the year. As of early February, Meta's capacity was fully deployed, and we are now fully servicing their contract. After delivering the first tranche of our Microsoft commitment on time, we expect to continue to deliver the remaining tranches throughout the year, with the majority expected in the second half. We expect Microsoft to begin contributing to revenue at the full annual run rate in 2027 once we have deployed all of the tranches. On adjusted EBITDA, we expect group adjusted EBITDA margin to be approximately 40% for 2026. We expect EBIT to remain at a loss in 2026 as we progress against our capacity expansion plans, deploy GPUs, and invest in R&D that will significantly enhance our technology stack and our future AI product. We believe the return on these investments are attractive and will remain committed to our medium-term EBIT target of 20 to 30%, with the potential to go higher. Starting in Q1 2026, we are updating our depreciation schedule from 4 years to 5 years to reflect what we are seeing in the market and in our current utilization commitments. This approach is aligned with accounting-based practices, and we continue to be conservative on this front. Now, turning to CapEx. In order to capture the large and growing opportunity that we see for the future, we plan to invest in CapEx in the range of $16 to $20 billion in 2026. We already have about 60% of the capital needed for this range from our balance sheet, existing operations, and commitments. We evaluate several funding options available to us on a consistent basis and will deploy 2 guardrails when we look at capital alternatives. First, we will focus on raising debt relative to our business needs and will be prudent with respect to the cost of capital. Second, we will be mindful about the shareholder dilution if we choose to issue equity. Given our balance sheet and minimal debt, we are fortunate to have many additional options to finance our growing business. For example, we are currently exploring adding corporate debt and asset-backed financing to our balance sheet. Our at-the-market equity program, which we have not used at all to date, remains an additional alternative for opportunistic capital. In addition, our equity stakes in ClickHouse and other businesses such as AV Ride can also be future sources of capital. We are excited about these holdings, especially as the market recognizes their significant value. As an example, it was recently reported that ClickHouse valuation was approximately $15 billion in the most recent funding round. So the wide array of funding options available to us allows us to fund growth in a way that is balanced, disciplined, and aligned with returns that rather than committing to a single path. In conclusion, 2025 was a year of strategic progress for Nebius, and we executed with focus and discipline across our business, generating strong momentum as we enter 2026. In the year ahead, we will continue to scale rapidly to capture the meaningful market opportunity in this once-in-a-generation moment in our space. And with that, I will turn the call back over to Arkady.
Yeah, before we turn the call over to Q&A, I want to provide one more update. After this earnings call, Neil Doshi, our VP of Investor Relations, is moving into a new strategy function role, and we would like to thank Neil for all his great work in building out of our IR function to date. And I'm also extremely pleased to welcome Gili Naftalovich, who will be our new VP of Investor Relations. Gili brings with her deep research and strategic finance experience from Goldman Sachs, UBS, and Monday.com. And we're very excited to have her on board. With that, let's go to the Q&A.
Great. Right, we are just collecting some questions from the portal, and we will begin Q&A in just a moment. All right. The first question from our investors on the portal is, Nebius is moving quickly to both bring demand online and to build strong foundation for the future capacity. What are you seeing in the market that gives you conviction that the demand for AI will continue to justify these investments? Let's give that to Arkady.
Well, first of all, we all look around and see what's going on practically everywhere. How we change our habits in everyday private lives, what happens in our corporations, in our company, for example, how much of workloads are now utilizing AI capabilities, including coding. And actually, we now see all the industries actually changing. Look at a recent example again, coding, or look at the movie industry, or look at the research. Whatever you do now, you do it with AI. But again, these are just general notions, but our conviction is mostly based on what we're seeing directly in our business. We see very clear signals in all sectors of our business. First of all, in the large accounts, all large clients are talking to us, and not only to us, but the whole market about expanding and renting more capacity, more GPUs, because their AI businesses are growing. There is this ongoing conversations actually will lead to more contracts everywhere. But we are, as you know, much more focused on our AI cloud business. And in AI cloud, we have these two major sectors, AI startups and enterprise. And look at AI native customers, what happened to them in 2025. Some startups disappeared, but some of them are becoming real companies, real enterprises of the future. And they started getting traction. Their products became more and more, they're more and more used by their customers, and they're scaling quickly, scaling with real revenues, real demand. And what we see such customers, such companies who used to order hundreds of GPUs, thousands of GPUs, now they're ordering tens of thousands of GPUs. And this is actually is a magnitude of what we saw in the largest consumers last year. Frontier models were ordering tens of thousands of GPUs just a year, 2 years ago. Now it's yesterday's startups at this level. Again, this is real business. These are real customers of them paying real revenues. So AI traction is visible. There's a lot of customers from the sector, starting with Cursor or Rodo, Higgsfield, Photoroom, Genesis Molecular, different sectors, and they all have their first traction, and they're becoming, as we speak, becoming real companies. Actually, it's the future enterprises. And on the other hand, there's enterprise clients who involve more, and who are actually switching most of their everyday business process to AI and generate new profits through that AI implementations. We see the growing number of such customers, growing contracts from each of such a customer. The number of GPUs is growing. The duration of the contracts is growing. As I said, the average duration for new customers grew 50% last year. So from the signals we see from all the sectors of the market, from big clients, hyperscale labs, from AI startups, becoming enterprise clients, for enterprise going AI, everywhere we see positive signals, and we just need to build more for them, more data centers, more tools. And if we could build faster and even more than we have today, we would do it. So we're building because it's clear growth.
Great. Thank you, Arkady. Next question is from Josh Baer from Morgan Stanley, who asks about our CapEx financing plans. You know, especially now that we have 16 to 20 billion of CapEx guidance out there. You know, how are we thinking through to meet these expectations for CapEx? Ophir?
Hi, I'm Ophir Nave, the COO and board member of Nebius. Usually I'm not participating in these calls, but given the importance of this question, both for our business and as well as to the investor community, I will take this one. Basically, this question has two parts. First, what is the optimal capital expenditure for our business in 2026? And second, how is this CapEx, how this CapEx is going to be financed? And obviously these questions are connected, related. So let us start actually with the second question, or the second part. How are we going to finance the CapEx? So obviously, we will first finance it from our cash flows. We have our cash on hand. We have cash that is generated from our core business. But most importantly, I would say, we have significant amount of cash that we received and will continue to receive in 2026 from the favorable terms of our long-term contracts. We are talking about significant amount of cash. This cash flows will actually finance the majority, actually around 60%, maybe even more, of all of our CapEx needs in 2026. So how are we going to finance the remaining amount, the rest? So as we all know, we have a very healthy balance sheet. By the way, not by coincidence, because we are working very hard to have a very prudent, disciplined, healthy balance sheet. As of today, we don't have any corporate level debt. We don't have any asset-backed financing, even though we have multi-billion-dollar revenues from long-term contracts. We don't have any bank revolver. And we didn't have it to date by choice. But moving into 2026, and as we all know, an optimal capital structure in our business should include also that. This should obviously be changed. And we plan during 2026 to use some of the tools that I mentioned in order to move toward a more optimal capital structure. So having said all that, from the financing point of view, we believe that the $16 to $20 billion capex makes a ton of sense. And we will be able to finance it while keeping a very healthy, disciplined balance sheet. But moving to the first part, the first question, what should be our optimal capex for 2026? I would mention, actually, Arkady said it time and again, that given that we are fully vertically integrated company, our capex is basically divided into three parts. Less than 1% is used for securing power. And given the importance of power to our business, and given the importance of securing power for our future hypergrowth, we are moving full force ahead in order to secure as much power as possible, given the relatively low cost of it. And I think that on this call, it was mentioned that we already secured significant amount of power, and we will continue to do so. The second part of the capex, building the data centers. This is approximately 20% of the total capex. And we invested in building data centers. We invested this amount, and it turned out, as we expected, that it became one of the best investments that we made. Why? Because when we have data centers ready, or almost ready, where we can deploy GPUs in a very short period of time, we can sell this capacity in very attractive and favorable terms. We have done so to date, and we plan to do it also in the future. We see the demand, we see the interest, we have a clear visibility on the demand for the second half of 2026 and for 2027, both from our cloud clients, as well as from AI labs and hyperscalers. And we are positive that these investments, with the interest that we are getting from all these players, will play out again very beneficial for our company, as it does so in 2025. The remaining part of the CapEx is obviously to deploy the GPUs. Again, this is a significant part of the CapEx. The beauty is that we deploy the GPUs in a short time period when we have a great visibility about the demand and about the prices and about our margins and we are very happy. We don't view it as a very risky place to be. So, having said all that, we believe that the $16 to $20 billion capex for 2026 makes the most sense for us. First of all, it is based on our visibility on the demand for 2026, 2027. It's based on the interest that we are getting from various players, both in our cloud platform and the AI labs and the hyperscalers. It will enable us to meet our $7 to $9 billion ARR in 2026. But more importantly, it will also put the foundation for our hypergrowth in 2027 and behind. But speaking about CapEx and investments, I think that it was worthwhile also to address two additional points. One is the ATM. As you all know, we launched our ATM program last quarter. As of today, we didn't use it at all. Actually, we don't have any concrete plans to use it also in the near future. However, it's another tool in our toolbox that will enable us to use it when it will make the most sense for our business as well as our shareholders. And this is another tool that will enable us to keep a prudent, balanced, disciplined balance sheet. And another point that I think worth mentioning is obviously our non-core businesses. We are fortunate enough to have our 25% stake in ClickHouse and our ownership in Everite. These non-core businesses, these stakes, are worth many billions of dollars as of today. This is great, but it's less interesting by itself. And most importantly, we truly believe that these stakes will significantly increase in the midterm. And when they will do so, they will enable us to continue growing our business in a hyper-paced mode as we plan 2027 and behind, while using this capital and continue keeping a very disciplined balance sheet. We're really happy with this potential capital injections for the future. I think that I gave right an overview on the CapEx, the needs, and the ways to finance it.
That was very helpful, Ophir. Thank you. All right. Next question comes from Alex Platt, D.A. Davidson. Can you help us bridge to not only the 800 megawatts to 1 gigawatt of connected power guidance, but now to the 3 gigawatts of contracted power guidance by year end? Andre?
Yeah, thanks, Neil. Hello, everyone. So what we can see now is we are accelerating the build out and deployment of the capacity in 2026 greatly. And we expect that the acceleration will continue in 2027 and beyond that. So what we are doing is as Afir mentioned, we are doing the investments in building the foundation for the 2027 and for the further years. We are well on track of achieving our goals that we mentioned about 2026 of this 800 to 1 gigawatt goal around year end, and we do that by launching a lot of sites with a mix of smaller and larger projects, and some of our bigger projects starting to come online in the end of this year. And in addition to that, in addition to the sites that we mentioned today, we have a multiple ongoing projects, and we expect that some of these additional sites may materialize this year. So basically, we expect that the collocations will help us grow faster starting in Q2 this year and ramping throughout the year. And our own projects, which are substantial in size, will really start to ramp up in 2027 and beyond. And that relates directly to the contracted power.
Great. Thank you, Andrei. Andrei, maybe just staying with you. Andrew Beal from Arate is asking about an update on the New Jersey data center site.
Yeah, with the New Jersey, we are very pleased with the progress there. We delivered the first tranche to the Microsoft on time, and we are well on track to deliver the remaining commitments on time as well. We believe that our partners secured the components in the supply chain, and they're working extremely hard to get everything online. Well, we also have some safety margin buffer times in our projects. And well, all projects can have some fluctuation, but we have built our plans with a large margin of safety, and we have a high confidence of executing this.
Great. Thanks, Andrei. All right, looks like we have a question from Alex Duvall from Goldman Sachs. Looks like Nebius came in light on revenue versus consensus for Q4, but ARR was ahead of expectations. So which is the more meaningful metric, and are there any timing considerations? And then just more broadly, lumping this with the ARR question, can you help us understand the difference between ARR guidance of 7 to 9 billion and the revenue guide for 2026? So Dado, maybe you can take this.
Thanks. Let me take it one by one. On the first question, of course, we were very pleased with our ARR of $1.2 billion, which exceeded our ARR guide. Our revenue came in the middle of our guidance, which actually was what we anticipated. Look, as we are in a hyper-growth phase, ARR is the meta metric. Now, on the next question around the difference between ARR and revenue guidance, let me say that first and foremost, at Nebius, we are really taking a prudent approach to our revenue guidance as we communicated. In 2026, our guidance is $3 to $3.4 billion in revenue. The difference between ARR and revenue is logical. Our revenues and ARR reflect the deployment schedule of our capacity throughout the year, with the majority of this capacity being installed in the second half of the year, as Andrei mentioned. We need also to consider that our largest enterprise partnerships are also still ramping. So the revenue guide simply reflects the ramp up in capacity coming online.
Great. Thank you, Dado. Question from Alex Platt from D.A. Davidson. How should we think about your progress against the 7 to 9 billion of ARR guide? And are you really dependent on the large hyperscalers to get to that range? Mark, why don't you take this?
Thank you, Alex. First of all, let me clarify. Our 2026 ARR target is not dependent on any new mega deals. As we bring on our planned additional capacity, combined with the already strong pipeline and our go-to-market plans, we are very confident in our ability to deliver our 26 ARR target. Our continued success with AI natives and the early progress we've seen with ISVs and enterprises set the foundation for capturing the market this year. Based on the traction we are experiencing and our extensive research on our total market opportunity, we are leaning into the verticals we've already laid out: healthcare, life sciences, media and entertainment, physical AI, and retail, which give us ample runway to capture share and grow our business. While we are happy to service large strategic customers like hyperscalers, we will remain opportunistic with such large deals as we look to balance the opportunity with the long-term positioning we plan to achieve with our AI cloud.
Great, thank you, Mark. Now let's take a question from the portal. Can you provide an update on where you stand as it pertains to the delivery schedule with Microsoft and Meta, and remind us again about how those two contracts layer in throughout the year? Maybe on the first part, we'll have Andre, and then Dado, you can take the second part on the contract layering.
Yeah, thanks, Neil. As I mentioned earlier, the first tranche to Microsoft was delivered according to the plan in November, and the remaining capacity is on schedule, ongoing. All of the remaining tranches will be delivered throughout the whole 2026, and more than half of them will land during the second half of the year. About Meta, earlier in this month, we delivered both contracted tranches to Meta on time, and we just now fully in servicing stage. And Dada, can you comment the financials?
Of course. Thank you, Andrew. The deployments in Meta, as Andrew just mentioned, went live early February. As such, we expect to recognize 12 months of revenue for the first tranche and roughly 11 months for our second tranche. As for the Microsoft deal, we expect revenue to ramp over the course of the year in line with our plans to deliver the capacity tranches, which, as Andre mentioned also, will happen throughout the year, with the majority expected in the second half. So Microsoft deal will begin to deliver a full year revenue starting in 2027. And as we execute on these commitments, we expect them to contribute positively to our medium-term EBIT margin target of 20 to 30%.
Great, thanks, Dado. Another question from the portal. What drove the upside in the December 2025 ARR? And as you look into Q1, what are the demand trends that you're seeing in the market today? Mark, why don't you take this?
Certainly. The upside in December ARR came from solid execution and strong pricing and utilization. We continue to make great progress in adding new logos and expanding with existing customers. On the second point, we are seeing very strong pricing across all families of GPUs, and we are at full utilization as we continue to sell out all available capacity. On Q1 demand, it remains extremely robust, and we are seeing the same trends that we shared in 2H25 carrying into 26. The three things that give me tremendous confidence and excitement as we enter 26 are continued pipeline growth, positive deal trends, and the progress we're making with our vertical strategy. The pipeline creation trajectory in Q1 is on track to exceed $4 billion. And as we expand our available capacity and add sales coverage, we expect it to continue to increase. In terms of deal trends, they're all moving in the right direction. Deal terms are getting longer, and average deal sizes are increasing. In Q4, we saw nearly twice as many transactions completed for over 12 months in duration over what we succeeded with in Q3, while average selling prices increased by more than 50%. As an example, we are sold out of hoppers, and those that are coming up for renewal, often off of short reserve agreements, are getting renewed at 12 months or longer, while we're actually seeing pricing nudging up. Lastly, we're focusing on customers with premium workloads and use cases, which is resulting in superior terms, including increasing those who are willing to prepay for securing future capacity.
Right. Thanks, Mark. We have another question from the portal. There are headlines of data center equipment shortages in the market. How is Nebius handling this situation, ensuring access to these products? And do you expect it to have any impact on your deployment? I think, Andre, this would be for you.
Yeah, thanks, Neil. On data center delays. Well, generally building the data centers is a quite complex task, and no one can get away from all of the risks. But I think we are in a quite good shape of managing this risk. As you saw today, we are well ahead of our contracted power, and we are developing 9 contracted sites we announced today. And the main idea, the main strategy is to have the portfolio of sites so we are not dependent on any specific single data center project to achieve our guidances and deliver our plan. And it's pretty important to understand our differentiation. We're full stack cloud, allowing us to enjoy the flexibility that it provides, that we are not dependent on any sites. We can move the loads in between. We can provide it from different locations. We just operating to ensure that we have enough capacity. And the second one is we already contracted the majority of our long lead items around our own sites to be sure that to ensure the capacity deployment beyond 2026 as well. And the second part of the shortages is the memory and storage. The first important point is our largest deals with Microsoft and Meta. We were able to secure the necessary components last year for the full scope of those contracts. And we secured it in second half of 2025 before any price increase. And for the remaining, we are confident in our supply chain to get the parts we needed to continue to deliver the capacity.
Great. Andre, maybe sticking with you, a few of our analysts are asking, with the announced 9 new sites for data centers that are going to be a mix of owned and co-locations. How do you evaluate when you want to buy versus lease, and how do you expect this mix to shift longer term?
I think we discussed it quite a few times. So generally, we are focused on bringing most of our largest projects as self-developed projects. There are 3 main reasons. First, we get much better total cost of ownership with this. We have much more control over the execution of the project because we have expertise and experience of building our own sites. We also can achieve greater efficiency at scale because generally we tailor the design specifically for what we need and for our technical requirements. But this takes time, and we use leases and partnerships to fill the gaps before we are at a full speed with our own one. So just to sum up, the preference is to develop the infrastructure ourselves, but again, we still need the partners and leases occasionally to support the growth.
Great. Thank you, Andre. Next question from Josh Barrett, Morgan Stanley. It's really around the software stack. What are the most common software tools that your broader customer base, startups and large enterprises are using and paying for from your AI cloud? And what proportion of your customers utilize your software and services in addition to your compute capacity? And then any color on just how much ARR comes from the software stack today. Mark, why don't you take this?
Certainly. Thanks, Josh, for the question. As I think you know, our AI cloud is purpose-built for AI and is battle tested with our AI customer base. At this stage, 100% of our AI cloud customers are utilizing our AI cloud software, obviously. So we have 100% attach rate. We're very excited, by the way, about the new products that we've launched, like Token Factory and the Aether releases, which have opened up TAM and give us an opportunity to expand into enterprise. Our new acquisition of Tavily also extends our platform capabilities by providing agentic search for AI developers, creating more routes into accounts. Should also mention that we continue to see demand for embedded storage from customers across key verticals, including physical AI, media and entertainment, and healthcare and life sciences. As a result, we are creating solutions that are vertically specific to meet the demands of these customers. We're really in the early stages of our monetization journey, but our software and services make our platform sticky, which enables us to charge more on a relative per GPU hour. We are exploring other monetization models, including consumption-based, such as per token pricing with Token Factory. So, Josh, stay tuned for more on monetization in the future.
Great. Thanks, Mark. Another question from Alex Duvall from Goldman Sachs. It's really on the 40% EBITDA margin target that we gave. What gives us confidence in that? Dado, can you take this one?
Sure. Thanks for the question, Alex. Let me bring the bigger picture. Nebius is scaling, and as we do, so will our margins. Now, let's come to adjusted EBITDA margin guidance. In Q4, the group achieved adjusted EBITDA margin of 7%. And for 2026, we are expecting to reach 40%. We see a tremendous demand for our AI cloud business, and we are investing appropriately to serve this demand. As we reported, the margin of the core AI cloud business is actually significantly higher than the group. And as we scale the AI business, most of our revenue and margin will continue to be driven by the core AI business. So we expect, of course, the other businesses to still operate at EBITDA loss in 2026, but their contribution to EBITDA will be smaller and smaller. So the guidance of 40% adjusted EBITDA margin reflects the current expansion state of the business.
Great. Thank you, Dado. We have a few of our analysts, including James Kisner from Water Tower Research, asking about Tavily. What is the strategic rationale behind Tavily? How is this complementary to your existing offering? And really, is there a lot of demand for this product from your cloud customers? Roma, why don't you take this?
Yeah, thank you for the question. I was afraid we will not come to it. It's quite exciting event for us, and we're super excited to announce our first M&A deal with the acquisition of Tavily and welcome Tavily team and Tavily customers in Nebius family. Tavily is an agentic search company. They connect AI agents to the web, and it's very much fits in our strategy to become and to be the platform where
all the AI developers from startups and enterprises building their AI applications and engines. So really got quite a significant progress. They already serve many Fortune 500 customers, and they've got great adoption in developer community and loved by developers. We will continue to evaluate for potential acquisitions of the companies that can deepen customer engagement, stickiness, and increase our lifetime value and strengthen our positions as a full stack AI cloud provider. And this game is such large that we obviously will not build everything ourselves. We will be in the strategic opportunities and will be in the strategic partnerships moving forward, looking for the companies and partners that got a great product, great developer experience, and similar to ours DNA, to build a platform that will be loved by AI developers long term.
Great. Thank you, Roma. We have another question just on capital allocation and M&A, in terms of like build versus buy. Like Neho Chokshi is asking this from Northland. Arkady, when you're thinking about capital allocation, especially whether it's investing in capacity or doing M&A, how do you think about this?
Again, what we're building here, we're building one of the largest platforms for AI developers to build their applications. The largest platform means two dimensions: the scale and functionality, product. And we could allocate capital between these two dimensions. We need to build scale. That's why we need to build all these data centers and buy all those hundreds of thousands of GPUs. And we need to build the product, and we build this product both organically, internally by our own developers, but we will never cover everything. So we go into acquisitions, and we spend some capital to acquisitions as well to enhance our product, to get more talent, and ultimately to develop more and faster. And Tavili is a perfect example of such an acquisition. Hopefully not the last one.
Great. Thank you, Arkady. And I think we're at the top of the hour. So thank you, everyone, for joining our fourth quarter 2025 earnings call. And next quarter, Gili will be leading the earnings process. Thank you, everyone.
Man, you got a lot of nuggets there, guys.
Yeah. What was everyone's thoughts?
I mean, I think people were really a lot of funny comments in the chat. Like the CEO is just sitting in his throne playing the cat, and some other funny ones. But I do think as slow and as quiet as the CEO was, I think he dropped the best nuggets, in my opinion, on how they're going to be moving forward and funding their CapEx. He brought up the 25% ClickHouse stake. And so I think there's a lot of good information, though. I'm glad they answered a broader range of questions, too. I think they got a lot of good insight in a lot of different areas. So I was happy with the call. Obviously, it was a little quiet at times and hard to tell what they're saying.
Yeah.
But overall, great information.
I mean, revenue is 3 to 3.4
Which is
billion.
A little light compared to analysts. I just think analysts are.
I mean, let's forget about the analyst expectations right now, but the growth is insane. Like it's let's say 3.2 midpoint $billion. The company worth what, $20 billion right now. ARR, which means the exit rate, is going to be closer to $8 billion. Growing at this rate, this is insane. Adjusted EBITDA margins, what did it say, 40%, going from 7% to 40%. It's crazy. It's crazy, and we capex from, what was it, 16 to 20 billion dollars. There are clearly some deals or something that will be announced this year, And if not, then this means that the core business, they don't even need these deals anymore. The core business is just growing like crazy. So yeah, the stock is down 4% now, but if it goes down even more, I guess I'll take it because this is crazy.
Yeah, the 16 to 20 billion capex compared to 22 billion in market cap. Like, if you take out the ClickHouse stake, which is almost $4 billion, they're basically trading at what their capex is for 2026. Insane.
I think the most important part.
You got to adjust your mic or something. You're loud as ever.
Okay, sorry.
Yeah, coming a little hot.
Coming in a
better?
little hot.
Is it better now?
Maybe a little more.
Now?
Yeah.
You sure? I can.
I don't know. You sound loud.
It just still feels the same to me, to be honest.
Okay, now.
Yes,
much better.
Now you sound good. Yeah.
Okay, sorry. I don't know. I didn't change anything compared to before, but anyways, I think the most important nugget from this call is that more than 60% of capex is financed by prepayments, basically from the large contracts.
Yep.
And that's like over $10 billion in prepayments. Like, it's crazy. It's like it de-risks the story like significantly. They even said they don't want to use the ATM program. They will use, I mean, from the wording
in the near term.
Yeah, what I assumed was like when the stock pumps, we're going to sell some shares because why not? And we need capital, as much capital as possible. So that's the interpretation I got. Was like, we're okay. We don't need to issue shares like in the short term, but if the stock pumps, and it will inevitably, if everything is achieved, let's say, and if, well, I mean, obviously it's not inevitably in the short term, but if everything remains on track, I mean, it can't just go down forever if execution remains, let's say.
Yeah,
Right,
Neil, I think you were saying that you think there's a hyperscale deal, and they said in the call too that the ARR target is not contingent upon any new hyperscaler.
Yeah, no,
or mega
not
deals.
the ARR. I'm talking about because the capex is so big.
Yeah, but they also said the big players are in talk with them and in talk with everyone. So that's why I asked Neil to ask about Vera Rubin, because I think if they're deploying Vera Rubins in both the US and Europe in the second half of this year, I'm sure some of that capacity is reserved by a hyperscaler or a frontier model. Like, it's not obvious, of course, but it's quite logical that they want to secure as much capacity as possible from the new generations. I mean, I'm sure as soon as they knew that Nebius and even CoreWeave were going to have that capacity deployed in this year already, they probably got a bunch of calls saying we want that, because I mean, it's everyone wants the new generations. And it's also great to see that they're renewing offers with a higher price than before.
Yes.
That's another of the bear cases, like, oh, offers will get obsolete. Oh, Blackwells will get obsolete. Oh, poor AI infrastructure companies spending so much capex when everything is garbage after 2 years. Well, that's not what's happening. Maybe in a few years, but now they're even locking in over 12 months of contracts for offers. So I think this call, like, to me personally, was the most bullish call ever since I'm an investor, because they addressed a lot more topics than usual. They were a lot more clear than usual, and they specifically addressed almost all the bear cases. First, capex, they need a lot of cash. Okay, large deals, prepayments, cash mostly there. Second, GPUs obsolete. Yeah. Good luck, Michael Burry. Third, I don't even remember, but there was other.
I mean, depreciation period from 4 to 5 helps with GAAP net income.
I was expecting
on
them
paper,
to do that.
it's fine.
I mean, if they have contracts of 5 years, I mean, I don't think it makes sense. I like that they were being conservative, but it's still 5 against 6 from CoreWeave and hyperscaler, so it's still conservative. And I mean, if you're getting a contract for 5 years, it makes sense that the useful life is at least 5 years. So
Yeah.
I don't think it's any.
It helps for the on-paper results, which the
Yeah,
street would
exactly.
probably like. Yeah.
Yeah, I like the 4-year, but by the way, I think a lot of what you said as well, like that honestly wasn't even new news that Hopper and all of these chips were going to be fully booked out. I mean, Jensen's been saying that for some time. That's also why I don't think that the market moved at all on it, is because we knew this. Even like Ampere is fully booked out, you know, like, so
but prices went up.
Exciting.
That was the good part.
Say that again.
The chief revenue officer, he said that in the renewals that are coming, first, it's new that they are renewing at 12 months or more of duration, and second, he said that prices are even nudging up a bit, and that's, I mean,
yeah, but we knew that. Not even just across Nebius, across the entire market, we know that Hopper, hourly rental prices are going up.
Yeah.
So, I don't know if that's, yeah, there you go. So
yeah,
I would have expected that.
I think that chart was caused because of the. I mean,
Fly.
it's obviously bullish. I posted it, but I think the most important factor that caused that bump was AWS raising prices on H100s. So it could be like, we knew it, but it could be something particular to AWS. You feel me? Like, I was expecting this as well, but it could always be the case that it was like more because that sudden hike came when AWS announced some price hikes in a particular weekend. So I was expecting that, as you said, but not entirely sure, let's say. But I don't think it would be enough to move the market at all.
There was some comment, I missed it because I didn't. I'll have to go back in the transcript, where they talked about hyperscaler deals and how they're not pushing for hyperscaler deals or something like this.
I mean,
does this ring a bell?
They basically just said they're not counting out. Go ahead, Tevis. Go ahead.
Yeah, the ARR target is not contingent on hyperscaler deals, meaning that the 7 to 9 billion ARR range is going to get raised quite a few times, probably.
I think what they meant was that they don't need additional large deals to get there.
Right.
Like, it's not that it doesn't include the deal with Microsoft or Meta. It's that they don't need any additional deal. And as I was saying about Vera Rubin's, I mean, if they announce a new deal for Vera Rubin's, then the ARR will be significantly higher, like by the end of the year, because they expect to deploy it during the second half of the year. So I think I wouldn't raise ARR guidance at this point. It would be stupid. Like, they need some room to grow during the year. I mean, they can't really, and even I expect them, for example, in like 2 quarters or 3, maybe 3, it will be obvious, but to issue the 2027 ARR guidance, because they clearly said the head of infrastructure, Andrei Korolenko, he said that they have visibility into 2027. So that makes me think that they just don't want to throw any number right now. But for example, Mark, like the chief revenue officer, he said during this quarter, Q1, they were on track to create over $4 billion in pipeline. So they had already previously reserved, like pre-booked, more than half of this year ARR target, like between $7 and $9 billion. And in Q1, they're on track to generate over $4 billion in additional pipeline. So deals continue to come in, and if they're accepting them, it's because they are confident, at least, that they're going to have infrastructure to meet the demand and to meet those deals. Otherwise, they wouldn't be signing them, right? So I think we had a lot more clarity, but I think they're even more bullish than what the targets show, in terms of not really like the the revenue of between 3 and 3.4, because that depends on the deployments, as we said, like the timelines. But when it comes to 2027 and even like late 2026, let's say. But it's normal. I mean, they need to manage expectations. Otherwise, there's no surprise in next quarters.
Yeah, but with how many data centers are going to be coming online until the end of the year, like the strong suspicion is that there's going to be more hyperscaler deals. So
yeah, I agree with Neil. I expect another deal at least this year.
Yeah,
and that data center in Lille that we saw, maybe, because Vera Rubin's, they said both in the US and in Europe.
mm-hmm.
So, I mean,
can they even like scale it? Can they build it out that fast for the new data center to have Vera Rubin's? Because they said in the second half of 2026. So I was imagining like a co-location or existing data center or something like this.
Yeah, that's a good point. I wasn't able to read the article about this data center yet in Lille.
I haven't read it either.
I'd be surprised if they can get the data center set up and operational in 2026 with Vera Rubin's.
Yeah,
that'd be pretty impressive.
Okay, here's the article from Reuters. Oh, there's no like timeline.
Yeah, we got a whole lot of clarity and better news on the company, and I feel better about my position overall, and the market sinks it.
Yep.
I think
any
it
talk
was
of
the
capex,
capex, yeah. Capex guidance.
Any talk of capex is just immediately sell.
I mean, we see it across the board. Meta, Amazon, they all did the exact same thing.
I hedge my portfolio with NVIDIA shares.
Yeah, imagine if NVIDIA misses by 1 cent. I mean, we're all liquidated.
I don't know. It just can't happen.
No, it won't happen unless there is like a typo. It's like, oops, sorry, typo.
Oh, and I'm not sure if you listened, but they hired someone to run the earnings calls. So Arkady will probably be chilling. Like, it's probably the best day of his life.
I love that someone said that he go for a run before the call because every time he talked, he just took a big inhale. Like every sentence.
It's like, here we go again.
Yep.
I think people get
the first question was about demand. Like, guys, give him like at least a couple of warm-ups.
He basically said you just basically said it's just common sense. Like, come on. He's like the conversations you have outside, it was funny the way he explained it, but it basically just came down to it's just common sense. Like, come on. Okay,
so this data center in Lille is the one in Béthune, or what? Like, I don't know how to say it, because it's near Lille, which is there. Like, I'm reading it's not the one from Reuters, but I assume it's accurate, like an article about it. It's saying the facility will be built in Béthune near Lille on the site of a former bridge. Yeah, it's what Reuters were saying. According to the company, construction will roll out in phases, with initial capacity expected to go online by late summer, and around half of the sites operational by end of 2026. So it could be the Vera Rubin.
Interesting.
Like,
and how do you infer the sort of monetization potential of a 240 megawatt data center? What's the math on that?
I mean, it really depends on whether it's Vera Rubin's or like Blackwell's.
Right.
That's why I asked Neil to ask about Vera Rubin's, because it would be useful to have like at least an idea on the differences between unit economics. Because I've read many people saying that Vera Rubin's are going to be like
twice as much
better, a lot better in terms of unit economics. Like, not only margins, but even I mean, it's correlated, but like the prices, they're going to have some pricing power because they will be the first to market Like,
So sorry, I thought you meant the actual cost of the Vera Rubins, because I'm pretty sure the Vera Rubin NVL 72s are actually like I've heard rumors that Nvidia is actually expected to sell them on almost twice the cost per unit, about $5.7 million versus $3 million for the Blackwells.
yeah, but I think the renting prices will also compensate for that,
right?
At least in the initial deployments, because they will have, as I was saying, at least some kind of pricing power. Because I mean, everyone will want Vera Rubins, but the supply will obviously be tightened, maybe. But I mean,
Yeah.
I'm just speculating around this data center because it makes sense. But so then it's not that data center being built by the other company in Bethune or whatever. So they're really good at keeping secrets. Like I searched all over internet about data centers in Bethune, and I only found that little one from a different company. But they said in the job description at our co-location facility in Bethune. That's something I'm not really understanding properly. But
Are we sticking around to see how the market opens?
Of course. Why wouldn't we stick
Yeah,
around
like
to
after
see our
2 hours.
portfolios get?
After 2 hours and 20 minutes, why not wait 10 more to see blood?
I mean, all in all, regardless of the stock price, this is a good quarter. Analyst estimates, I mean, you can show them out of the window because it doesn't really change that much. The company's estimates are being beaten. The guidance for 26 is very good. I think we're still going to be very much surprised of what they're going to announce over the next couple of months and quarters. I feel like Nebius has a big advantage here, where first of all they already have like Microsoft Meta, or they had Cloudflare as enterprise company, Cursor, Shopify, things like that. The fact that they can deliver very, very good results at, I would say, close to record speed gives them a huge advantage, which is probably why big companies would want to work with them over others, because they have the experience, they already deliver the goods, which again makes me think that Meta will just come back for more, because why not? They're already seeing the results. They see that Nebius delivered. So why would they risk going with someone else? We know that they are going with CoreWeave as well, but why wouldn't they increase their partnership with Nebius? And then Nebius itself, I mean, their core business is not to have co-location deals or bare metal stuff. It's to grow their core business. And I think that's just also going to explode this year.
Yeah. I was just going to say, some of the concerns that I see some comments on are that they missed on earnings and that the call was boring. None of those things Nebius cares about at all. They don't set the targets. The targets that they set, they hit. And the call, I mean, these guys are not public speakers that like worry about how they talk with hyperscalers and if they can continue to, sign more contracts. I think, any company that's growing at triple digits and then, halfway to 4 digits, at growing at 500+% rates, you can kind of give them a pass on their lack of enthusiasm talking, essentially public speaking, So I think those are the wrong things to try to nitpick. Nitpick the business, not the...
And they're only a year and a half old company too, right? Like this is their 6th or 7th quarter as a team.
You can't have it all.
So,
I mean, as a Nebius, as a Yandex, they're pretty old.
Yeah.
If we have to pick between execution and good public speaking, I know where I would.
Yeah.
A detail that was also interesting was that they asked about memory and storage shortages. And Andre said that for the contract with Microsoft and Meta, they bought every everything they needed, like all the necessary components, last year before
nice.
the price hike is like from in the sector, which was also something that a lot of people were calling like a bear case. Like yesterday, I had a comment on my earnings preview saying, "Oh, it's impossible to get the Microsoft contract delivered on time. There's no memory. There's a RAM shortage. Don't you know this? This is basic." Well, at least it seems that's not a problem for the contract. I mean, maybe for future contracts that could be a good argument, but for now, which and I mean these contracts are more than half of the ARR to be achieved by year end, so margins are unaffected on that front, which makes that a problem for later. And now the market is getting supply from other places as well, so I think it's not a big deal for Nebius.
Someone says, actually disagree. The best leadership in the world are people who work delusionally hard to help their business. They take speaking classes because they know it matters. It's a sign of the best teams. For real, no.
Okay.
I mean, like,
is this a joke or serious? Like,
yeah,
like, bro, have you ever heard a Tesla earnings call?
Yeah, have you ever listened to Mark Zuckerberg talk? Like these most of the smartest leaders in the world are actual lizards. Like they're weird people. They're not they're not worried about their speaking classes.
Maybe we should give them a Duolingo super subscription.
Yeah,
Could pump up the stock and make the earnings call better.
English is like not even the primary language for these guys. Like they're just worried. They're computer geeks. Let them be computer geeks.
Yeah, exactly.
I mean, the time they would be wasting on that, they could deploy some GPUs.
Yeah. I'd be so pissed if they were taking speaking classes.
Yeah. Someone said here, like, they're probably tired from winning so much.
Yeah.
Coding is their primary language.
They can for real just hire somebody to talk. I mean,
yeah.
It's literally what Shopify did. I mean, Harley Finkelstein is their essentially spokesperson of the business. It's like Toby's just a nerd that doesn't want to talk. You know? Sorry, I got Shopify. That's not the first time I mentioned it in this call. It's burning my books
PTSD
right
from
now.
yesterday.
Yeah.
Yeah, but that's because I mentioned it. So Canadian companies.
Open the damn market. I want to suffer.
Wait until CoreWeave's call. Yeah, I know. Even more CapEx. It's going to be...
Is it today? Or
no, not sure. No,
CoreWeave?
No.
I have no idea. I mean, I'm genuinely...
I don't know CoreWeave either.
It's
26th of February.
Yeah, 14 days.
Okay.
They just don't have to be late again, like to have delays. Like
but they asked
quarter.
Nebius in this call about that as well, like about the potential delays. I mean, this guy, I love this guy. I mean, he's not the good public speaker as well, like Andrei Korlenko, but he was the head of infrastructure at Yandex for over 20 years, like in a row. Before coming to Nebius. I mean, this is not his first rodeo, man. I mean, he obviously knows how to deploy infrastructure at a large scale like very few people in the world. I mean, a lot of people might be skeptical. Oh, he's Russian. Oh, he comes from Yandex. Oh, data centers were not AI data centers. I mean, give me one person that have been deploying large-scale infrastructure for over 20 years before. I mean, there must be someone, of course, but there are very little people in the world with this experience. And he's showing over and over again how important that is.
And working with a team that you used to do that with before, right?
Exactly.
You know how everyone works, and now you're
who's
just
good at
tackling a much bigger challenge.
Exactly. You know, that guy is good at that. That guy is good at this. That guy is good at this.
I still have to laugh at the fact that Dan Ives put Nebius at the top of the list of companies that are going to be acquired in 2026.
Yeah, I totally disagree with that take.
Poor guy. No disrespect, of course.
This team's not selling. Unless it's something ridiculous. But they're not selling.
Yeah,
I'm still like crazy about the fact that over 60% of CapEx.
I know. I thought I misheard that because he talked so quietly. I was like, I thought I
to
heard
me,
16. I was like 60?
Yeah, to me that's the big point of this call.
What was this, sorry?
They said that over 60% of CapEx is funded by basically prepayments from the large countries.
The cash flow, yeah.
Because I mean, again, no disrespect for Iron, but shareholders have been trashing Nebius because they got a $2 billion prepayment from Microsoft. They've been saying, our terms are way better than Nebius. We got a prepayment. Where the hell is your prepayment? You're going to have to get so much debt. You're fucked. And first they say that we don't know anything about the terms and that's bad. Then they say the terms are better than our terms, but they don't even know our terms. And I thought the $2 billion prepayment to Iron was pretty good, and the financing deal on that contract was good as well. I'm not trashing them at all. I'm just trashing the people that trashed us with no good justification. Because I mean, over 60% of this is more than $10 billion. Like it's crazy. I don't even know like how this is possible. Even if it was just like $5 billion, it would be crazy. Or even like to me, it's the highlight of the call because it de-risks the story.
It's the first time we've heard the CEO on the call too. I believe.
Yeah, I think I'm not sure if he joined recently.
I know he definitely wasn't on the last one. I know that for sure.
I mean, he announced himself.
Yeah, it was dude. He took that answer took like 15 minutes, but he just spewed on about everything.
He went on autopilot for a second there.
He literally, yeah.
I couldn't understand a word at first.
Like it took him like 3 minutes just to frame the question. Now let me go back to answer. It was hilarious.
The market's opening right now. Okay, it's open. The market's open. I don't have a bell or anything like this. But Crocs is up 18.5%.
There you go. We are open, ladies and gents. Let's see what's going on here. Oh, my rocket is slowly but surely.
Oh my gosh, Iren's down, AppLovin's down 13.5%.
I mean, Nebius is down 8, so we're getting there.
Yeah.
Crypto is green for those interested, but it doesn't really mean much.
What's that? Crypto.
Let's not I'm a shareholder too. You got one of the enemies in the chat right now. Yeah, kick him. Yeah. I think that was good. He was talking crap about crypto.
He just disappeared.
He literally saw Nebius down 9%. And he's like, I'm out of here.
Yeah, that's enough for me.
Oops. I guess I was. Oh, what the hell? I don't even know what happened.
You see, Duolingo is green because of the language lessons that we are going to offer.
We just got 2 more customers.
Duolingo green after shareholders buy Nebius team premium version of the app.
At the end of the day, all the live streams turn into transcripts and no one even knows that. Like, it'll be about the material in the call rather than how they were said. Still no mention of Uber. I mean, it's a very small part, but yeah, they probably should have brought it up. It was in the call, or sorry, it was in the press release. The AV Ride Uber partnership.
Yeah. Ooh. Adyen is down 16% today.
Yeah, it's had earnings as well.
Yeah.
We're just in a market where anything non-tech is going up, anything tech is going down. I mean, regardless of earnings.
Yeah, no matter how good. I mean,
Fastly Nvidia is up
55%.
Nvidia should be up.
What did you say? Fastly is up?
Is up
like
55%.
Wow.
Yeah.
60%. But I mean, they really had good earnings. I just saw the headlines. But
I mean, last quarter they jumped 36%, and then it went all the way back to pre-earnings, and now it's up. Okay.
Now it's up 61.
That's crazy.
That is.
So, I guess the rebound of Nebius will start now.
Let's see.
I could buy some more shares. I could turn this thing green again.
Yeah, give us that big candle there, Jack.
I'm just kidding. I got 0 cash, guys. I just used it all up.
That's a shame. Boop.
Very interesting.
Right.
Yeah, maybe that was the bottom. Broke underneath 80, and now we head higher.
Yeah, maybe not.
I can't call
does
for it in this market, but yeah.
Does it even matter? Probably not.
No.
Probably not. This is a $20 billion, $22 billion company. If you believe it can reach $100 billion in the future, who cares about $2, $3 here and there? Plus, the market right now is really not in a giving mood. Like, nobody can win. The AI winners cannot win. The AI losers cannot win. So, nobody's
all about
winning
Crocs,
in this market.
baby.
Who knew? Crocs is the way to go.
I mean,
all right.
they're AI resilient. You know?
Yeah.
No Crocs CapEx.
Which is probably why Apple has been doing well.
Crocs is all I'll be able to afford after this next sell-off is done. Just rubber shoes.
Okay, well, ladies and gentlemen, this has been your latest episode of Getting Liquidated Weekly, and yeah.
No, we only close the stream when the stock is green.
Oh, okay. Buckle up, guys.
We're going to be here for a while.
I'm gonna have to recline my chair for that. Okay.
All right.
I want to go get
ladies and gents. Thank you all for joining. We shall see each other in the next one.